For most Americans, retirement is supposed to represent freedom. Freedom from work schedules, freedom from commuting, freedom from decades of stress and financial pressure. But what many retirees never realize is that one of the most financially dangerous deadlines in retirement arrives years after they stop working, and for millions of Americans, that deadline begins at age 73. Because once you reach that age, the IRS starts forcing withdrawals from many retirement accounts whether you need the money or not. These are called required minimum distributions, or RMDs. And while most retirees have heard the term before, very few fully understand how dangerous these rules can become when multiple accounts, Social Security income, Medicare premiums, and tax thresholds all begin colliding at the same time. Many retirees spend decades building traditional retirement accounts because they were told tax deferral was the smartest strategy available. Contribute to the $401,000, max out the IRA, delay taxes until retirement. And for years that approach appears to work perfectly because balances grow tax deferred while working income remains high. But eventually the IRS wants its share, and after age 73, the government no longer gives retirees complete control over withdrawal timing. The IRS forces taxable distributions annually, and this is where many retirement plans begin unraveling unexpectedly, because the problem is not just the withdrawals themselves. The real problem is how those withdrawals affect every other part of retirement income simultaneously. A larger IRA withdrawal can increase taxable income. Higher taxable income can trigger more Social Security taxation. More income can raise Medicare IRMAA surcharges. Larger balances create larger future withdrawals, and suddenly retirees discover that taxes in retirement can actually become more aggressive later in life rather than lower. This is why many financial professionals now encourage retirees to review 5 specific account categories before age 73 arrives. The first and most obvious account category is the traditional IRA. Millions of retirees hold the majority of their wealth inside traditional IRAs because they spent decades rolling over old $401,000 balances from previous employers. At first glance, large IRA balances look reassuring, but after age 73, those same balances can become tax concentration traps. Imagine a retiree with a $1.5 million traditional IRA. Once required minimum distributions begin, annual withdrawals may become large enough to push the retiree into higher tax brackets even if spending needs remain relatively modest. And because those withdrawals are taxable, the IRS effectively controls a growing portion of retirement cash flow. This becomes even more dangerous for surviving spouses because single filer tax brackets are significantly narrower than married filing jointly brackets. The second account category retirees often review before age 73 involves old employer $401,000 plans still sitting at multiple institutions. Many retirees leave former workplace accounts untouched for years without realizing they are creating future complexity. Multiple accounts mean multiple RMD calculations, multiple withdrawal schedules, and potentially larger administrative confusion later in life. Some retirees consolidate strategically before required minimum distributions. Begin simply to simplify future withdrawal management and tax planning. Again, the goal is not avoiding taxes illegally. The goal is controlling timing before flexibility disappears. The third dangerous account category involves taxable brokerage accounts with large unrealized capital gains. Many retirees assume brokerage accounts are safer than retirement accounts because they are not subject to RMD rules directly, but capital gains still interact with taxable income calculations, Medicare thresholds, and Social Security taxation. If retirees delay all tax planning until age 73, they may suddenly discover they have very little flexibility left to realize gains strategically at lower tax rates. Some households intentionally begin harvesting gains gradually during lower income retirement years before RMD pressure begins stacking on top. Timing matters enormously. Because once RMDs begin, every additional dollar of income can trigger cascading tax consequences elsewhere. The fourth account category many retirees underestimate is cash-heavy savings positions such as CDs, money market accounts, and high-interest savings accounts. At first glance, cash feels safe, no market volatility, no investment complexity. But many retirees fail to account for how taxable interest income compounds alongside required minimum distributions later. Inflation quietly erodes purchasing power while taxable interest increases reported income. Then once RMDs start arriving, retirees suddenly face taxable IRA withdrawals, taxable interest income, and potentially taxable Social Security simultaneously. This stacking effect is what catches so many households off guard because no single account appears dangerous independently, but together they can create significant tax pressure. The fifth account category may be the most misunderstood of all: Roth IRAs that were never properly utilized early enough. Roth accounts generally avoid required minimum distributions during the original owner's lifetime, making them incredibly valuable from a tax flexibility standpoint. But many retirees wait too long to consider Roth conversion opportunities. Some spend decades accumulating only tax-deferred balances, then realize too late that nearly every future withdrawal will become taxable after age 73. This is why many retirement strategists discuss partial Roth conversions during lower income years before RMDs begin. Yes, taxes are paid during the conversion process, but some retirees intentionally accept smaller tax bills earlier to potentially avoid much larger forced taxation later. Now, to be clear, no single withdrawal strategy works for everyone. The correct approach depends on total assets, marital status, pensions, healthcare costs, estate goals, and future income expectations. But nearly every retirement planner agrees on one critical principle. Retirees who plan before age 73 usually have more flexibility than retirees who wait until after RMDs already begin. Another issue many Americans never anticipate is how Medicare IRMAA surcharges interact with retirement income. Medicare premiums are tied to income levels from previous tax years. That means one large withdrawal today can increase healthcare costs years later. Retirees often focus only on federal income taxes while completely overlooking future Medicare consequences tied to higher reported income. Social Security taxation creates another layer of complexity. Many retirees assume Social Security benefits are mostly tax-free. But depending on total combined income, up to 85% of benefits may become taxable, and once RMDs begin stacking on top of other income sources, retirees may cross taxation thresholds much faster than expected. This creates what some planners describe as a retirement tax avalanche, where one additional withdrawal unexpectedly triggers multiple financial consequences at once. The emotional side of this problem is important too, because many retirees spent their working years believing retirement would finally simplify their finances. Instead, they enter a phase where taxes, Medicare calculations, account sequencing, and withdrawal timing become more complicated than ever. Some households even become afraid to withdraw money they worked their entire lives to save because they worry about triggering larger taxes and surcharges accidentally. That's why retirement planning today is no longer just about investment growth. It's increasingly about withdrawal coordination and tax efficiency over time. The retirees who preserve the most long-term flexibility are often the ones who begin planning years before mandatory deadlines arrive. They review account concentration. They understand future RMD projections. They analyze tax brackets proactively instead of reactively. And most importantly, they avoid assuming retirement automatically means lower taxes forever. Because in many cases, the most dangerous tax years happen decades after retirement begins. At the end of the day, the IRS does not care whether retirees actually need their required minimum distributions. Once age 73 arrives, the rules change, and for Americans holding large tax-deferred balances, those rules can quietly reshape retirement income, Medicare costs, Social Security taxation, and long-term financial stability. That's why reviewing these 5 account categories before required minimum distributions begin could become one of the most important retirement protection decisions many families ever make. And if you want to continue learning about hidden IRS retirement traps, Social Security taxation, Roth conversion timing, Medicare surcharges, and the financial mistakes many retirees never see coming until it's too late, subscribe to Michael Retires Shield for future retirement warning breakdowns and protection strategies.